Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Okay, so good morning, good afternoon, good evening, and welcome to the Live Squawk preview stream. Again, we haven't changed the title yet, but we will do, and we'll get a better, a more interesting one for you guys to enjoy. I'm joined today. Well, the whole point of today is a preview of the US non-farm payroll for September. With jobs now ever more important to the outlook for Fed monetary policy, all eyes are on the labour market and its performance. And therefore, we think it deserves a bit more focus. Just to get all the usual stuff out of the way, for those who are unaware, Live Squawk is a live audio news service that services financial market investors and traders. We're up to the second reporters on the news and any headlines that matter to you guys that trade the many asset classes out there. So if you want to trial the service, please go to livesquawk.com and take out a free trial and see what you think. Right, back to today's event. And as I said, we're looking at the US non-farm payroll number. And to help guide me and you through today's number, I've got two veterans of the financial markets, really. Mr. Top Steps, Danny Riley. I think he's on board. He's a long-time friend of Live Squawk and runs a really good chat room service for traders. Please check it out, Mr. Top. I'll put the links up afterwards. Mr. Top Steps, Danny Riley, welcome. And also today we're joined by Jeffrey Hirsch, who dedicates his time and knowledge to arming traders and investors with the information and insight to make more profitable trades and investments. And they're joining me from the other side of the pond, I think in Chicago and New York, respectively. Right, getting into today's number, then we'll take a look at expectations ahead of non-farm payrolls and what the consensus is. So we're looking for the headline number to come in at 150,000. That would keep it, again, roughly in line with what we've seen of late, 142,000 for the last month. In terms of private payrolls, that's expected to see 125,000 gains after 118,000 last time out. Manufacturing payrolls expected to fall by 8,000 after a drop of 24,000 previously. The all-important unemployment rate expected at 4.2%, which will keep it aligned with last month. Turning to wages, and average hourly earnings on the month over month expected up 0.3%. That's 0.10. That's a 0.1 softer than previously. Year over year expected at 3.8, which will keep it also in line with previous. Labour force participation rate expected at 62.7%, also unchanged. And last month we saw the underemployment rate at 7.9%. For anyone who wants to read up on the number, I've written a piece that's on our website and on social media platforms. It's titled "US Labour Data to Guide Monetary Policy Debate," which is it does what it says on the tin. Just to give you a couple of the bank research pieces that we've got here. I'm going to read from Bank of America Global Research. They say their US economist team expects 150,000 headline non-farm payrolls and a 4.2% unemployment rate. This would leave the 3 and 6 month averages at circa 130 to 140,000 respectively. The Fed would likely view such data as in line with their forecasts and the summary of economic projections. Our base case would see the market modestly pare back November cut expectations, but still retain some optionality of a 50 basis point cut. The 50 basis point optionality is driven by data yet to come before the November FOMC, September inflation and October NFP. We think a soft employment report is likely to generate a larger market response versus a strong labour report. And just one more quick report here from the likes of SocGen. They also look for 150,000 for this month. If this projection materializes, the bank says it will represent an improvement over recent gains, but still may not be robust enough to alleviate the concerns raised by recent employment data. The job gains coupled with the unemployment rate are likely to influence the 25 basis point option when assessing the November FOMC meeting. Additionally, Fed officials will take into account the October employment release scheduled for the 1st of November when they convene for the next FOMC on the 6th and 7th. The unemployment rate is anticipated to hold its 4.2%. Wage growth is showing signs of moderation. So to get back to our guests, I'd like to introduce to, let me get, I've got Jeff here, and we're still waiting on Danny to join. But basically, we'll start with Jeff. Jeff, welcome.
Morning. Excuse me. Morning, Harry.
Hey, first time guest on the show. Thank you very much for agreeing to take part. What are your initial views around today's NFP release?
Well, I mean, it's important. Everyone's looking at it. You captured it pretty well. Last month we did downtick just a tad. I mean, that we had our big shot across the bow from the Fed with the 50 points. Looking at the CME Fed Watch tool and what we're thinking here, I'm not expecting the 50 next time. I think coming out of the blocks with it gives them the ability to be a little more patient. And with growth looking like it's going to moderate, GDP wise in the U.S. in Q3 after the 3% in Q2. I think Atlanta Fed's got it at 2.5% right now. I could see it just being kind of in line, and with the volatility overseas, the geopolitical turmoil. I know that the dock workers strike was paused. There's a lot of uncertainty around the election as well, and global events in the U.S. I think the Fed's going to be hard pressed to do too much without the data coming in. So if it's a bad number, if it's really weak, that changes the calculus quite a bit. But from my vantage point right now, I think we're looking at something in line, a continuation of the little downtick we had last month, or keeping it flat, and then a couple of quarter point cuts at the next two meetings in November and December. That's where my thinking is.
Okay, so based on what you think, the long and short of it is this number is one of those holding pattern numbers today to see if we can establish the trend that we've seen of late, which is probably, if I'm correct, slightly softer outlook, but still seen as a fairly steady and solid pace of job creation.
Yeah, the word we're using for the economy and these numbers is resilient, not robust, but resilient. It's a big economy. It's been through some serious ups and downs over the past few years. With COVID and the big inflation and the 22 bear. So resilience and holding pattern steady, like you're mentioning, is okay by me.
Yeah, big time. I mean, do you see where are there any risks to today's number, or any, like you said, unless it's a particularly weak one, you don't really see too much in the way of any changes to the dynamics or the expectations? Do you see any specific risks within today's report? Obviously, the dock workers, that's now, we hope, has been resolved. But I think there was a Boeing issue as well, wasn't there, in terms of union disruptions as well. So are you happy that we're in a decent place, a resilient place, as you say, for the number overall?
Yeah, I mean, I think that the risk is if it's surprisingly weak. I don't think the dock workers is going to impact this number. I think that would be next month if I'm getting it correctly. I think that won't hit the number until the next reading, which will be another issue we can talk about. But I see the risk right now really the Mideast and China, and that strike was alleviated, but we're also with the focus of the world on what's going on in the Mediterranean and the Middle East there. I wonder what Russia and China are it just leaves us open to some things over there. So it's October. I'm a seasonal guy. We got the October phobia, the tendency for the market to have the volatility that we're seeing here. It's also kind of ironic to me, not ironic, that we're having these sort of global global volatility during this time of the year when things sort of change over on the planet. So it's just kind of human behavior playing out. So the risks to me are really global turmoil right now, not the jobs number.
Yeah, sure. And so on that front, if we take a look, for example, at the Middle East situation, it's a very fluid situation. Obviously, oil's decided to kick in now, and there is a lot more hedging going through the markets, I guess, as this situation escalates. In terms of where you see that, and we're looking overall now, not just at today's non-farm payroll, these vulnerabilities, do you see the inflation issue maybe potentially ticking up? Again, like you said, we've yet to see how this port worker strike may affect numbers down the line. And we're not necessarily seeing any transport issues at the moment around this Middle East. But again, these things are cumulative and they tend to build up over time. So again, are your eyes trained in terms of what you would advise traders or what you'd talk to traders about? It is more about this global geopolitical issue and issues around that.
Yeah, I mean, I think it does have the potential to stall the disinflationary period or just the disinflationary trend that we're on. We haven't hit the Fed's 2% number. The trend has been great, going down, but things like this turmoil and the strike can definitely impact inflation. And this dual mandate is a bit of a double-edged sword. It makes it hard to be perfect on it, and they're never perfect. But I mean, they got to sort of walk that line between economic resilience and labor market stability as well as pricing. I mean, the big talk around the world, around the country, and especially with the election coming, is how expensive everything is. And I'm not sure how much of it's really true or just sort of rhetoric, but it's definitely an issue that's in people's mind is pricing and the inflation stuff and how expensive things are. So the Fed's going to be careful with that. And they might have been late coming in with raising rates to combat the COVID spending generated inflation, but it seems like they've learned a little something here, and I'm not of the camp that they're late with the cuts. They seem to be engineering a decent or a softish landing. Yeah, there's going to be some bumps, a little bit of turbulence on the way down, or as we touch down, if at all. But they seem to be on the right track, and they seem to be pretty prudent. And now, the thing that changed with the Fed in the recent, couple of decades is they became, they try to lead the market a little bit more. And there's some old minutes that we've gone through where it talks about the Fed, keeping this, the old Volcker minutes from 81, where, we'll keep the window at 15 to 21% unless something happens in the bond market.
Sure.
And we're seeing the Fed almost letting the bond market lead again like it should. And that, I think, is a positive for monetary policy and the markets themselves. When you have this, this entity, the bond market, that really is the best economist out there, leading where rates should go, and it's a much healthier environment from my view.
Yeah, so it's a prescribed path. Where you can see within the rates what's expected, where it's supposed to be, and there are no surprises for the markets.
Where the Fed sort of monitors or puts up the guardrails and isn't really dictating interest rates. It's just sort of keeping things from going off the rails.
Right. Which is that as I said, it's not supposed to be the main star of the show, is it? It's supposed to
Correct.
be to just guide free markets in that sense, and expect it. So from your perspective, then we've got earnings season coming up as well next week. Do you have any kind of views on the US economy from the corporate perspective, and do you see the start of the earnings season as a positive? Do you think it helps markets in terms of bringing out positive reports?
Well, I think it's been a little mixed, but overall, it's been better than expected, better than the worst fear mongers. I mean, and honestly, for me, this earnings season, this time of year is where I sort of like start wringing my hands. I'm getting excited for running our stock screens. This is, the seasonal sweet spot for us.
Right.
And we're going to be looking for our seasonal buy signal using, some MACD technical triggers overlaid with our best 6 months and best 8 month switching strategies to get back into the market. And then once we get those buy signals, we start digging in for some stocks, and we look for off the radar, under the radar, undervalued stocks that are they're underfollowed by Wall Street, but kicking off some acceleration of growth in revenues and earnings. So I'm looking for the numbers that in stocks that people aren't talking about, and so I'm just kind of chomping at the bit here for earnings season for the numbers to settle, and for me to be able to get in there and find some winners for my subscribers and members.
So in that sense, I mean, I was talking to a guest yesterday, and they were talking about under the analysts of underplay, and just their forecasts maybe on the light side, and so when they do come in and outperform, it just gives a further lift. How much do you think's built into Q3 earnings in terms of the, I guess, the upside? Do you think there's still a decent upside play? Obviously, we have, like you touched upon, we've got elections coming up, and on who comes in, it will very much swing the, I guess, just the confidence in the market.
All right. Yeah, the thing about the election, the key is that, and what's going to give the market the confidence is there being a decision quickly. Anything that's dragged out, any sort of, I want to say mishigas, which is a little Yiddish that I dial up. Any sort of craziness,
Right.
like we had in 2000 or in 20, anything that's like not, confirmed quickly, either the night of or the morning after. I think that's where the problem lies. It doesn't matter who wins or loses per se. It's about there being a smooth transition and there being, a decision made. With the stocks and the earnings numbers and what the analysts say, all due respect, I don't really listen to what the other analysts say. I don't really care. I want stocks that are throwing off numbers that in their 10Ks and 10Qs sequentially and year over year, that are growing and accelerating growth, and that analysts aren't seeing yet. Okay. So that's another game. You want to play the stuff that everyone's talking about, that's fine. We do that as well. But I do see a positive fourth quarter. All the analogs that I'm looking at with election years and the seasonal patterns and the macro trends that we're talking about with the economy and corporate numbers and the technicals as well. I mean, we look at, we're a seasonal house, basically seasonal shop, but we're looking at fundamentals, technicals, monetary policy, as we're talking about here, and sentiment. And I just see a lot of all of those factors generally pointing to more highs towards the year end. We've seen the bulk of the gains for this year. My annual forecast was in the 15 to 25% range. We're at around 20, or we were a couple of days ago for S&P and NASDAQ. So that gives us another 5% or so for by the time we get towards year end. I do expect some pullback here, some volatility and consolidation here in October, which is super typical. But it creates a nice buying opportunity for us, and it's setting up a good potential technical trigger with our indicators.
Okay, awesome. Just to really sort of round off, Danny, I think, has had some issues with his comms, so I don't think he'll be able to join us for this show. But just to sort of to highlight your views, and so labor market in your investing, in your trading cycle, what proportion would you put on looking at this data between now and the next Fed meeting, for example, as opposed to what you're looking at from earnings? And how would you put this in percentage terms, where your focus will be for the majority of the rest of the year, for example? You think monetary policy is fairly well set if we're looking at 5 basis points? So that's less of a concern for you. Therefore, and I'm just putting words in your mouth, therefore the data is less of a concern for you. So maybe you're looking at more at the corporate side to give you that impetus. Would that be correct, or am I?
I mean, the things that I'm concerned with or looking at right now. I mean, I think the economic numbers are on track. The corporate numbers seem to be relatively on track as well. The election uncertainty, the global uncertainty, the heightened tensions is really where I'm at right now. Not through the end of the year, but for the next 30 days up through the election, or maybe 40 days or whatever it is,
Sure.
4 or 5 weeks. That's where my concern is, my focus is right now. And then we'll be looking at the corporate numbers, doing our stop picks. We just put out our ETF sector recommendations. The overlay of our seasonals with some buy limits and stuff below the market. So we're really just sort of in the gates, waiting to jump out, waiting for the technicals to give us the to blow the whistle and tell us to go. So
Okay.
We're sort of set up and ready.
Okay, good to know.
We've been in the cash and bond side for the last several months during the weak months, so we're just chomping the bit, waiting for a fat pitch.
No, fair play. Thank you. Right. Well, listen. I'd like to thank you very much for your insights today, because again, although this number probably not the most exciting of numbers we're going to have this year, it's still important in the chain of events leading up to the next Fed rate decision, I guess, and really into year end now. We're in the home stretch of this year, so people wanting to protect their portfolios and maybe if they haven't made as much as they want, try and add a bit more money to their year. This is a key part of the year, I guess, on that front. But yeah, thank you very much, Jeff. We'd love to. Please send me any links and anything you want me to push as well, because
Sure.
I think our audience would very much like to hear and see what you have on offer, really, and I would like to show them.
Most definitely, I will put it into the chat. I did retweet and tag it out there, so it's went out through my stream or my feed, and I appreciate you having me. It's been fun. Let's do it again.
Yeah, absolutely. Thank you very much, guys. That was Jeff Hirsch, and again, as I said, I'll put the links up so that you can look at the content there. Just to really recap then on what we're looking for from today, getting back to today's numbers on our platforms there, you'll see the bank estimates that we have for today's number. But just to give you the key pointers from today's non-farm payroll and what to expect. Right, the consensus is for 150,000 in terms of the payrolls. Unemployment rate expected at 4.2%, which will keep it aligned with last month. And we're looking in terms of wages, average hourly wages on the month, over 0.3%. That'll be down a tenth from last month, and expected to stay at 3.8% on a year-over-year basis. A quick look also at labour force participation rate, expected at 62.7%. Average weekly hours, 34.3%. Just a quick note here also from Rabobank. They point to where we're tying this in with the Fed and how the Fed see this now as labour as an integral part of their policy-making decision. At his Jackson Hole speech in August, Fed Chair Powell stated that it is unlikely that the labour market will be a source of elevated inflationary pressure anytime soon, and also stressed that the Fed would not seek or welcome further cooling in labour market conditions. Rabobank says these two statements were interpreted by the market as meaning that the inflation risks were no longer the focus of policymakers, and that any undue loosening in the labour market would provide the spark for further rate cuts. Again, not all Fed officials share Powell's confidence. Bowman recently commented that inflation remains uncomfortably above the committee's 2% goal, while Barkin repeated that it was too early to declare victory on inflation. But again, this is where we're at, and this is where the market's at in terms of what it views as the most important and key data for the Fed moving forward, and therefore for what rate traders and others are looking at. So yeah, just to give you that as a heads up, last bit of research from Citi here. They say payroll, job growth and the unemployment rate are now the two most important data points released each month, and we expect both to show further weakening in the labour market in September. They pencil in 70,000 in payrolls and unemployment rate rising to 4.3%. But bearing in mind, they've been particularly dovish in their calls, and at one point we're looking for 350 basis point rate cuts before year end. That was ahead of the September meeting. They then revised that to 25 at the September meeting, which is, and we got 50. And then, but they do still see they're on the more dovish path really for the Fed. Just to finish what they say, job growth in the last few months has slowed broadly across sectors. But if anything, we have been surprised that job growth has not slowed more in sectors such as construction, leisure, hospitality, and see growing risks of a sharper pullback in these industries. While 70,000 jobs growth is not much softer than recent meetings after revisions, the further weakening trend with the unemployment rate close to the Fed's year-end forecast should solidify market pricing for our base case of another 50 basis point cut in November. Okay, well, listen, thank you very much for listening. The number is out in just 40 minutes from now. So 50 minutes from now. So please take a trial of livesquawk.com if you want to hear the number and just see what else we do, because I think, well, a testament to being around for 20 years, we're a good aid for traders. And thank you for listening, and have a good trading day. Have a good Friday. And best of luck. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.